What's up, everybody? Jeremy Lang, the Mortgage Bro here, checking in. As of yesterday, there was an update to the overnight lending rate by the Bank of Canada. They bumped theirs up by 1/4 percentage point, which means that all the lenders are going to now increase their prime rate by 1/4%. So it was at 2.95, as you can see here, now at 3.2%. So if you have a variable rate mortgage or a home equity line of credit or any other type of loan or a vehicle, financial vehicle associated with with prime rather, that will be changing. So the overall cost on this, it's $13 per 100,000. It is not a gigantic amount. It's the exact same amount as it was last time. So marginal impact. Likely though, if you are in a variable rate mortgage, you probably have reasonably good discounting on that. So it'll be, subtracted from prime. So you may well be in a very, very good position still, even with the interest rate increase. Something to think about though, of course, is there are a few options. You can stay in the mortgage that you're currently in. Totally fine to do that and kind of ride the wave out. We're not sure what speculation is there yet to see how this change will impact the overall economy, and then what that looks like moving forward. We'll have to wait for things to kind of settle a little bit in the coming weeks, and we'll see if there is a speculation of a further adjustment in the future. The other option, of course, you can lock in. So you're probably in a 5-year term, maybe you've got a 3-year term on your variable. The option there is that you can actually lock in. So if you're, say, a couple years into your term, you'd be able to lock into the equivalent 3-year fixed rate. That's only if you're 2 years. 1 year, 4, of course, you can do all the rest of the math. So that is an option there. It is definitely worth talking to myself or your mortgage broker. Absolutely figure out if it makes the most financial sense to lock in. It's likely that your interest rate will actually be going up if you do lock in for that equivalent rate. So definitely worth the conversation. The last item here, you could actually go and prepay. So what that means is some mortgages have the ability to increase the payment. It may well be worth it if it's financially feasible for you to actually increase your payment above what's already required. The idea behind this is kind of imagining a duck swimming along on the water, and its legs are going like this, but it's nice and calm on the top. So what you're doing is you're building in an insulator against possible future rate increases because you're already actually paying more. So if there is some undulations on the rate, nothing to worry about because you're just kind of cruising along. That is well worth looking at because, of course, any additional that you pay off your mortgage ahead of time comes straight off the principal, so you are lowering your overall cost of borrowing. As I said, if you have questions about the status of your mortgage, you would like to talk to me about that, please do give me a call anytime. I'd love to chat with you about that. Or, of course, if there's anything else that you have in relating to mortgages, I'm always here. Anyways, again, Jeremy Lang, the Mortgage Bro. I'll talk to you soon. Bye.